Pressure on the Russian economy did not arrive suddenly or without warning. It built quietly over years as structural dependencies hardened beneath apparent stability. To understand today's strain, the underlying economic design must be examined first. Russia's economy is heavily concentrated around energy exports and commodity-driven revenues. Oil, natural gas, metals, and fertilizers dominate foreign earnings and fiscal inflows. This export structure delivered predictable cash flow during periods of stable global access. Energy revenues funded government budgets, currency stability, and domestic social spending. As long as exports moved freely, the economic system appeared resilient and controlled. However, concentration reduces flexibility when conditions change unexpectedly. Diversification slows when a dominant sector continues generating sufficient returns. Manufacturing innovation remained limited compared to similarly sized developed economies. Capital markets stayed relatively shallow despite large nominal economic output. The system became optimized for energy extraction rather than broad-based productivity growth. This specialization matters when pressure enters through external channels. Russia's financial system depends on global trade infrastructure more than commonly assumed. Energy exports require shipping insurance, clearing banks, and compliant international buyers. Foreign currency revenues must pass through global settlement mechanisms. Reserve assets must remain liquid to stabilize exchange rates and financial confidence. Access confidence matters as much as physical access itself. Once confidence weakens, transaction costs rise immediately across multiple sectors. Even before recent shocks, Russia faced several internal economic constraints. Demographic decline slowly tightened the labor market and reduced long-term growth potential. Productivity growth stagnated as investment efficiency declined over several years. Foreign direct investment remained cautious due to persistent geopolitical risk premiums. Existing sanctions frameworks already restricted certain technologies and financial instruments. These conditions were manageable individually, but dangerous in combination. They reduced economic margin for error significantly. When margin narrows, shocks transmit faster and more forcefully. Financial markets react first, long before households feel direct consequences. Currency markets price expectations within hours, not policy outcomes. Bond yields adjust before factories slow or layoffs appear. Trade contracts renegotiate terms before production volumes change. Economic pressure therefore appears financial before becoming physical. Russia's central bank maintained substantial reserves to absorb volatility. These reserves provided insulation against short-term market disruptions. However, reserves function as shock absorbers, not growth engines. They perform best under predictable inflows and stable access conditions. When uncertainty rises, reserves shift into defensive deployment. Defensive use stabilizes systems, but consumes capacity rapidly. At the same time, trade routes experience friction. Logistics costs rise as insurers price elevated risk exposure. Shipping delays create inventory shortages and timing mismatches. Energy discounts widen to retain buyers amid uncertainty. Discounts reduce revenue per unit without increasing production volume. Lower margins directly affect fiscal capacity over time. Budget pressure builds quietly before becoming politically visible. Currency markets respond to perceived access risk immediately. Ruble weakness increases import costs across critical industries. Imports include machinery, components, software, and industrial equipment. Even resource-heavy economies rely on imported technological systems. No modern economy operates independently from global supply networks. Financial pressure, therefore, spreads horizontally across sectors. Banks tighten lending standards to preserve balance sheet stability. Businesses delay investment and hiring amid uncertainty. Consumers increase precautionary savings when confidence weakens. Economic growth slows before recession is officially declared. Meanwhile, the state absorbs higher stabilization costs. Supporting the currency drains reserves incrementally over time. Subsidizing strategic sectors increases fiscal obligations. Maintaining price stability requires tighter monetary conditions. Tighter policy constrains domestic credit expansion. Credit contraction slows investment further. This feedback loop defines modern economic pressure cycles. It represents compression rather than immediate collapse. Compression reduces resilience to future shocks significantly. When a sudden event occurs, reactions become amplified. Costs that were theoretical convert into real losses rapidly. Markets reprice risk instantly without waiting for confirmation. Capital seeks safety before political clarity emerges. This is how pressure concentrates at the core. Russia's economy now operates inside this compressed environment. Every new disruption carries disproportionate impact. Energy revenues continue flowing, but under constrained conditions. Trade persists, but at higher cost and lower efficiency. Financial stability remains, but with increasing intervention. These signals indicate strain, not immediate failure. But strain reshapes decision-making across the entire system. Policy options narrow as trade-offs become sharper. Short-term stability competes directly with long-term capacity. This is where cumulative cost begins forming, not from one event, but from layered adjustments. Understanding this structure explains the present pressure. The issue is not a single action. It is how much absorption capacity remains. The sudden pressure intensified when multiple economic stressors converged within a compressed financial environment. Currency markets reacted first, reflecting expectations rather than confirmed policy announcements or official statements. The ruble faced immediate volatility as traders reassessed access, liquidity, and future settlement pathways. Weaker currency levels increased import costs across machinery, electronics, and industrial input categories. Higher import prices fed directly into producer costs within manufacturing and energy support industries. Producers absorbed margins initially, delaying consumer price transmission where possible. However, sustained cost increases eventually passed through supply chains. Inflation expectations adjusted upward, forcing monetary authorities into defensive positioning. Interest rates became a primary stabilization tool under growing uncertainty. Higher rates stabilized currency pressures, but constrained domestic credit availability. Credit tightening affected small enterprises before larger state-aligned corporations. Investment decisions slowed as borrowing costs rose and outlook clarity diminished. Capital expenditure delays reduced productivity improvements, already lagging pre-shock trends. Foreign investors reassessed exposure due to settlement, compliance, and exit uncertainties. Risk premiums widened across Russian sovereign and corporate debt instruments. Higher yields increased refinancing costs for both public and private borrowers. Debt rollover became more expensive, tightening fiscal and corporate flexibility. Energy exports continued, but pricing dynamics shifted under constrained buyer leverage. Discounted pricing emerged as a tool to preserve export volumes. Volume stability masked declining revenue efficiency within export earnings. Lower revenue efficiency directly affected budgetary inflows over successive quarters. Fiscal buffers absorbed initial impact, delaying visible expenditure adjustments. However, sustained revenue pressure narrowed discretionary spending capacity. Public investment projects faced prioritization rather than expansion. Infrastructure maintenance schedules extended as resource allocation tightened. These adjustments reduced multiplier effects across regional economies. Logistics networks experienced higher insurance premiums and compliance-related delays. Shipping timelines lengthened, complicating inventory management for exporters and importers. Supply reliability concerns encouraged additional stockpiling, increasing working capital requirements. Working capital strain affected cash flow predictability for mid-sized enterprises. The sudden pressure intensified when multiple economic stressors converged within a compressed financial environment. Currency markets reacted first, reflecting expectations rather than confirmed policy announcements or official statements. The ruble faced immediate volatility as traders reassessed access, liquidity, and future settlement pathways. Weaker currency levels increased import costs across machinery, electronics, and industrial input categories. Higher import prices fed directly into producer costs within manufacturing and energy support industries. Producers absorbed margins initially, delaying consumer price transmission where possible. However, sustained cost increases eventually passed through supply chains. Inflation expectations adjusted upward, forcing monetary authorities into defensive positioning. Interest rates became a primary stabilization tool under growing uncertainty. Higher rates stabilized currency pressures, but constrained domestic credit availability. Credit tightening affected small enterprises before larger, state-aligned corporations. Investment decisions slowed as borrowing costs rose and outlook clarity diminished. Capital expenditure delays reduced productivity improvements already lagging pre-shock trends. Foreign investors reassessed exposure due to settlement, compliance, and exit uncertainties. Risk premiums widened across Russian sovereign and corporate debt instruments. Higher yields increased refinancing costs for both public and private borrowers. Debt rollover became more expensive, tightening fiscal and corporate flexibility. Energy exports continued, but pricing dynamics shifted under constrained buyer leverage. Discounted pricing emerged as a tool to preserve export volumes. Volume stability masked declining revenue efficiency within export earnings. Lower revenue efficiency directly affected budgetary inflows over successive quarters. Fiscal buffers absorbed initial impact, delaying visible expenditure adjustments. However, sustained revenue pressure narrowed discretionary spending capacity. Public investment projects faced prioritization rather than expansion. Infrastructure maintenance schedules extended as resource allocation tightened. These adjustments reduced multiplier effects across regional economies. Logistics networks experienced higher insurance premiums and compliance-related delays. Shipping timelines lengthened, complicating inventory management for exporters and importers. Supply reliability concerns encouraged additional stockpiling, increasing working capital requirements. Working capital strain affected cash flow predictability for mid-sized enterprises. Labor markets responded with hiring freezes rather than immediate layoffs. Wage growth moderated as employers managed rising non-labor costs. Household purchasing power weakened through combined inflation and wage stagnation effects. Consumption growth slowed, particularly for discretionary goods and services. Retail sectors observed volume softness before price-driven revenue changes. Tax receipts reflected nominal stability but real purchasing erosion underneath. Government stabilization measures targeted critical sectors selectively. Selective support avoided systemic collapse but reinforced uneven sectoral outcomes. Financial institutions increased liquidity buffers to manage volatility exposure. Higher liquidity reduced lending aggressiveness across risk-sensitive portfolios. Payment systems adapted to alternative routing arrangements where necessary. Adaptation incurred additional transaction costs and operational complexity. Operational complexity increased compliance staffing and procedural overhead. These frictions accumulated gradually rather than explosively. Economic stress manifested through compounding inefficiencies rather than singular disruption. Trade partners adjusted terms cautiously, emphasizing reliability over expansion. Long-term contracts faced renegotiation clauses tied to delivery certainty. Renegotiations limited future revenue predictability for exporters. Market sentiment remained sensitive to incremental developments rather than isolated events. Each adjustment reinforced cautious behavior across financial and commercial actors. This cautious equilibrium defined the second phase of pressure transmission. The economy remained functional but increasingly constrained. Growth potential narrowed as stabilization replaced expansion priorities. This phase set conditions for deeper cost realization ahead. As pressures persisted, adjustment costs shifted from markets toward households and regional budgets. Fiscal authorities prioritized stability, redirecting resources to buffers while postponing longer-term development plans. Such reallocations preserved short-term order, but reduced future capacity to absorb additional shocks. Regional governments faced tighter transfers, forcing trade-offs between services, maintenance, and investment. Municipal projects slowed as financing windows narrowed and procurement timelines lengthened nationwide. Households adjusted consumption baskets, substituting imports with domestic alternatives of varying quality. Substitution reduced exposure, but raised dissatisfaction as choice narrowed and reliability fluctuated. Energy sector operations continued, yet upstream investments declined amid uncertainty over returns. Deferred investment today implies constrained output tomorrow, even when demand remains available. Maintenance backlogs accumulated gradually, increasing operational risk and future capital requirements substantially. Transportation networks absorbed higher costs through fees, rerouting, and compliance-driven delays nationwide. These frictions translated into price dispersion across regions, complicating nationwide supply coordination. Small exporters faced disproportionate burdens compared with vertically integrated, state-linked enterprises larger. Financial supervision emphasized resilience, encouraging conservative balance sheets and higher capital buffers. Conservatism improved stability metrics, but suppressed credit creation during a delicate adjustment phase. Trade partners diversified sourcing strategies, reducing dependence and bargaining leverage for suppliers. Contractual flexibility declined as buyers sought shorter tenors and contingency clauses widely. Shorter tenors increased rollover frequency, amplifying exposure to market sentiment shifts abrupt. Meanwhile, parallel payment arrangements expanded, adding layers of cost and operational risk. Operational risk management demanded additional staffing, systems, and compliance verification efforts nationwide. Cumulatively, these adjustments lowered total factor productivity across multiple tradable sectors, domestic. Lower productivity constrained wage growth, reinforcing household caution and slower consumption recovery. Public communication stressed adaptability, while policy quietly prioritized risk containment across institutions. This divergence between messaging and mechanics reflected the economics of uncertainty management. Over time, uncertainty taxes. Investment decisions, even without headline disruptions, sustained major. Capital allocation favors liquidity and optionality when future access remains unclear globally. Optionality preserves survival, but postpones scale, innovation, and productivity gains meaningful long-term. As months passed, compounding costs outweighed one-time shock absorption benefits initial earlier. Policy space narrowed further as trade-offs intensified between growth, stability, and fiscal balance. At this stage, pressure translated into slower momentum rather than abrupt breakdown. Slower momentum still carries consequences, especially for long-run competitiveness and incomes nationwide. The adjustment phase thus redefined priorities, emphasizing endurance over expansion temporarily across. Such endurance depends on institutional capacity, credibility, and sustained access channels reliably. Where access remains constrained, costs persist, even after volatility subsides materially longer. This persistence explains why pressure feels ongoing rather than episodic economically speaking. The economy adapts, but adaptation itself carries measurable recurring expenses for participants. These expenses define the real cost of sudden pressure over time periods. Understanding this phase clarifies why recovery depends on restoring predictable access conditions. Without predictability, stabilization remains defensive and growth remains deferred across sectors widely. As costs accumulated, strategic economic decisions shifted from expansion toward preservation across institutions. Preservation logic favors control, redundancy, and reliability over speed, efficiency, and innovation. State policy increasingly emphasized self-sufficiency within constrained external access conditions. Self-sufficiency reduced vulnerability, but raised production costs and lowered competitive benchmarks. Import substitution programs expanded despite mixed evidence of efficiency gains historically. Domestic producers filled gaps unevenly, constrained by scale, technology, and capital access. Quality differentials persisted, affecting downstream industries reliant on precision inputs. Research and development spending faced pressure amid budget prioritization for stabilization. Lower research intensity affects productivity trajectories with significant time lags. Education and talent retention became harder as opportunity costs widened domestically. Skilled labor mobility preferences shifted toward stability rather than growth opportunities. This preference change subtly reduced entrepreneurial activity and risk-taking behavior. Entrepreneurship declines reduce innovation diffusion across regional economies gradually. Financial planning horizons shortened across firms facing uncertain access conditions. Shorter horizons favor cash flow optimization over long-term capacity building. Capital expenditure delays compounded earlier investment slowdowns observed pre-shock. Infrastructure renewal cycles lengthened, increasing life cycle costs over time. Transport, energy, and utilities systems require continuous upgrading to maintain efficiency. Deferred upgrades increase failure risk and future capital intensity substantially. Trade diversification efforts progressed, but required time and negotiation complexity. New partners demanded pricing concessions and compliance adaptations, increasing transaction costs. These concessions reduced net export revenues compared with pre-pressure baselines. Fiscal authorities balanced reserve preservation against social spending commitments carefully. Social spending adjustments aimed to protect essential services while limiting deficits. However, constrained budgets reduced discretionary stimulus options significantly. Monetary authorities continued prioritizing stability over credit-led growth strategies. Tight monetary conditions suppressed inflation volatility but restrained domestic demand. Domestic demand restraint limited multiplier effects across services and manufacturing. Regional disparities widened as adjustment capacity varied by sector exposure. Export-oriented regions adapted differently from consumption-driven urban centers. Uneven adaptation complicated nationwide policy calibration and targeting. Corporate consolidation increased as scale advantages improved resilience under pressure. Consolidation reduced competition in certain sectors, affecting prices and innovation. Price signals became less reflective of competitive dynamics in concentrated markets. This distortion introduced efficiency losses beyond immediate shock effects. Over time, such losses accumulate into measurable growth differentials. External observers noted stabilization without corresponding productivity recovery signals. Stability alone does not restore growth potential without renewed access certainty. Access certainty influences investment, trade terms, and technology transfers simultaneously. Without it, economies operate below potential, despite functional systems. This phase marked the transition from shock response to structural adjustment. Structural adjustment determines long-term trajectory more than initial disruption magnitude. As prolonged pressure settles, the economy enters a phase where consequences become structural rather than temporary. What began as stabilization evolves into a lasting redefinition of incentives, priorities, and economic behavior. Costs are no longer absorbed quietly, but embedded into pricing, productivity, and long-term growth potential. This is how sudden pressure reshapes an economy long after headlines fade. Understanding these mechanics matters because similar pressures emerge across many global economies today. The lessons here extend beyond one country, one moment, or one shock. If this analysis helped clarify how economic pressure truly works, stay connected for deeper explorations ahead. Subscribe to follow future examinations of economies under stress and the costs they quietly accumulate.